It wasn't a glitch in the inventory data, it wasn't a standard hedge against industrial demand for solar panels, it wasn't even a speculative bet by a rogue trader looking for a bonus, it was the quiet execution of a defensive strategy that precedes a monetary regime change. The numbers are public, the implications are hidden in plain sight. 169 million ounces, that is the scale of the position. It is a fortress of physical metal. It sits in vaults that are deep underground. It is distinct from paper derivatives. It is distinct from unallocated accounts. It is title-held physical mass. When the largest banking institution in the United States moves with this level of aggression, you do not look at the daily chart, you do not look at the moving averages, you look at the incentives. You look at the structural constraints, you look at the history of what happens when the architect of the paper market suddenly decides to corner the physical exit. Most observers see a commodity trade, they see a bet on green energy. They see a wager on electronics manufacturing. They are missing the signal. The signal is not about industrial consumption. The signal is about currency failure. The signal is about the repricing of risk in a system that has lost its anchor. History is clear on this sequence. First, the smart money provides the liquidity for the paper game. They profit from the volatility. They manage the spread. Then, the arithmetic changes. The debt load becomes mathematically impossible to service at positive real yields. The currency requires debasement to sustain the sovereign bond market. At that precise moment, the smart money stops selling insurance. They stop underwriting the paper. They take delivery. They do not announce this shift. They do not hold press conferences. They simply stand for delivery. They move the collateral from the registered category to eligible, then they move it out of the warehouse entirely. This creates a vacuum supply shock, a squeeze that has nothing to do with mining output and everything to do with the velocity of money. The pattern is unmistakable. We have seen this before. We have seen it in the 1930s. We have seen it in the 1970s. We saw the precursor in 2008. And now, the data suggests we are entering the terminal phase of the current cycle. This isn't prophecy. It's positioning under constraints. When you examine the ledger of financial history, you find that the movement of physical silver is rarely about the metal itself. It is almost always a proxy for the confidence or lack thereof in the liability side of the central bank's balance sheet. The accumulation of 169 million ounces by a single entity, or a cluster of entities operating under a single custodial umbrella, is not a market operation, it is a withdrawal of faith. To understand why this is happening now, and why the magnitude of this position signals a squeeze of historical proportions, we must look at three specific case files where elite positioning anticipated a collapse in the prevailing monetary order. Case file 1 takes us to the twilight of the classical gold standard, specifically the chaotic interlude between 1931 and 1933. The popular narrative of the Great Depression focuses on the stock market crash of 1929 and the subsequent unemployment lines. However, the real story, the one that determined the transfer of generational wealth, was the war against the gold peg in 1931. Britain abandoned the gold standard, the pound sterling. The reserve currency of the 19th century collapsed in value overnight. This was the warning shot. In the United States, the banking elite, the Morgans, the Warburgs, the predecessors of the very institutions we watch today, understood the arithmetic. They knew the Federal Reserve could not defend the dollar-s peg to gold at $20.67 while simultaneously bailing out a collapsing banking system. The constraints were absolute. You can have a fixed exchange rate or you can have a bailout, but you cannot have both. The positioning began in earnest in 1932. While the public was being urged to keep their money in banks to show patriotism, and while retail investors were desperate for yield in a deflationary environment, the insiders were moving liquidity out of the banking system and into physical specie. They were not buying stocks. They were not buying bonds. They were converting paper claims into gold and silver. By early 1933, the outflow of gold from the New York Federal Reserve was hemorrhaging at a rate that made suspension inevitable. The smart money knew that the revaluation was coming. They understood that to clear the debt, the dollar had to be devalued against real assets. When Franklin Roosevelt signed Executive Order 6102 in April 1933, criminalizing the possession of monetary gold, the trap snapped shut on the public. but the positioning had already occurred crucially. While gold was confiscated, silver offered a different path. The Silver Purchase Act of 1934 followed, effectively nationalizing silver but at a price that was significantly higher than the market rate had been just years prior. Those who had positioned themselves in physical metal outside the immediate reach of the banking holidays preserved their purchasing power. The dollar was devalued by roughly 40% in 1934. If you held paper, you lost 40% of your labor. If you held the metal, you repriced effortlessly. The incentive for the elite was not to break the law, but to anticipate the law. They understood that when a sovereign state faces a debt crisis, it will change the rules of money. The rational move was to own the thing that the state would eventually have to revalue. Case file 2 moves us forward to the inflationary crisis of the late 1970s. This era is often remembered for the Hunt brothers and their famous attempt to corner the silver market. The media narrative paints the Hunts as greedy speculators who tried to manipulate the price and failed. This is a convenient cover story that obscures the deeper structural reality of that decade. The Hunt brothers were not operating in a vacuum. They were responding to the destruction of the dollar following Nixon's closing of the gold window in 1971. Throughout the 1970s, the Federal Reserve, under Arthur Burns and later G. William Miller, printed money to finance the guns and butter policy, the Vietnam War, and the Great Society programs. The inflation was not a mystery, it was a policy choice. The smart money saw the CPI prints rising from 3% to 6%, then to 10%. They realized that holding U.S. Treasury bonds was a guaranteed loss. The positioning of the elite during this period was a massive rotation out of financial assets and into hard assets. It wasn't just the Hunts. European banking families and Middle Eastern sovereign wealth funds began aggressively accumulating silver and gold. The Hunt brothers' accumulation was merely the most visible tip of the iceberg. By late 1979, the price of silver had exploded from under $5 to nearly $50 per ounce. This was a tenfold increase, a 1,000% move. What is critical to understand here is the mechanism of the squeeze. It wasn't just that people wanted silver. The exchanges, the COMEX and the CBO faced a crisis. They had sold more paper contracts than there was physical silver to deliver. This is the short squeeze dynamic. The exchange officials, realizing the shorts, who were largely the bullion banks, were about to be obliterated, changed the rules. They raised margin requirements. They instituted liquidation-only trading. They forced the price down by regulatory fiat to save the establishment. But here is the key takeaway for our current situation. Before the crash, the transfer of wealth had already happened. Those who bought at $4, $5, or $6 and sold into the mania, or simply held through the volatility, preserved their wealth while the bond market was decimated. The positioning was driven by the recognition that the Federal Reserve had lost control of inflation. The incentive was to own the only asset that had no counterparty risk. The squeeze was the symptom. The disease was the currency debasement. Case File 3 brings us to the modern era, specifically the aftermath of the 2008 global financial crisis and the curious case of the JPMorgan takeover of Bear Stearns. In March 2008, the investment bank Bear Stearns collapsed. The official story is that it failed due to exposure to subprime mortgages. They had bet heavily that the price of silver would drop or stay contained. When the price began to rise, they faced a margin call they could not meet. The Federal Reserve and the Treasury orchestrated a shotgun marriage, forcing JPMorgan to acquire Bear Stearns. When JPMorgan absorbed Bear Stearns, they inherited this massive short position. They became the new short seller. For the next 2 years, market observers noted that JPMorgan seemed to be suppressing the price to unwind this toxic position. But then something shifted. Around 2011, after silver peaked near $50 again and corrected, the data began to show a change in behavior. JPMorgan stopped being the net short. They began to accumulate physical metal. They opened their own precious metals vault in New York, the largest in the world, and applied for it to be COMEX approved. The incentive structure had inverted. During the 2010s, with quantitative easing becoming permanent, the bank understood that the next crisis would require even more liquidity than 2008. They moved from being the entity betting against gold and silver to the entity owning the physical float. This was not a trade for the next quarter. This was a strategic pivot for the next generation. They effectively cornered the market not to drive the price up immediately, but to control the supply when the inevitable currency crisis arrived. This brings us to the mechanics of the constraint engine. Why do these massive entities move into physical metal? It is not because they like the shine. In a normal financial environment, a treasury bond is considered risk-free. It pays interest, and it is liquid. Silver and gold pay no interest and cost money to store. In a normal world, the rational move is to hold bonds. But we are not in a normal world. And most of Europe, the central bank cannot raise interest rates high enough to fight inflation without bankrupting the government. If they raise rates to 5 or 6%, the interest expense on the national debt consumes the entire tax revenue. This creates a fiscal dominance regime. The central bank is forced to print money to buy the government's debt. This guarantees inflation. It guarantees negative real yields. Under these constraints, the bond is no longer an asset. It is a liability. It is a guaranteed loss of purchasing power. The big players, the banks, the sovereign funds, the billionaires, see this? They run the math. The incentive shifts from return on capital to return of capital. They need an asset that is not someone else's liability. They need an asset that cannot be printed. They need an asset that has no counterparty risk. This is where the 169 million ounces becomes significant. It represents the removal of that metal from the liquid float. In the silver market, there are two types of inventory: registered and eligible. Registered silver is available for delivery against futures contracts. Eligible silver is sitting in the vault but is not for sale at current prices. The data currently suggests a massive draining of registered silver. It is being moved to eligible, or it is leaving the vault entirely. When JPMorgan or similar entities stockpile this metal, they are effectively removing the buffer. They are thinning the market. Think of it like a dam. The water level is the available physical silver. The paper market, the derivatives, the futures contracts are boats floating on top. As long as the water is deep, the boats can maneuver. But the big players are draining the water. They are taking the physical metal out eventually. The water level drops so low that the boats run aground. The paper contracts cannot be settled in metal. They must be settled in cash. Or the exchange must declare force majeure. This is the squeeze. It is not about a group of Redditors buying coins. It is about the wholesale removal of the physical collateral that underpins the entire pricing mechanism. The 500% squeeze mentioned in the title is not a random number. It is based on the historical ratio of paper claims to physical ounces. Some estimates suggest there are hundreds of paper ounces for every single physical ounce available for delivery. If even a small fraction of those paper holders demand the metal, the price cannot adjust linearly. It must gap higher. It must revalue to a level where the holders are willing to sell. Mapping this to the present day, the warning signs are flashing red. We are seeing the convergence of three distinct pressures. First, the geopolitical fracture. The BRICS nations and other central banks are aggressively buying gold and silver. Moving away from the dollar system, this reduces the global supply available for the West. Second, the industrial demand. The push for net zero and electrification requires massive amounts of silver for solar panels, EVs, and electronics. This demand is inelastic. They need the metal regardless of the price. Third, the monetary debasement, the return of inflation, and the looming pivot of the Federal Reserve back to easy money. The stockpile of 169 million ounces is the fortress built to withstand these pressures. It indicates that the smart money expects a break in the supply chain. They expect a moment where you simply cannot source the metal at the screen price. There is a counterargument, of course. Economic skeptics will point out that silver has been a widowmaker trade for decades. They will argue that the banks can suppress the price indefinitely using paper derivatives. They will cite the vast above-ground stockpiles of silver jewelry and silverware that could flood the market if prices rise. They argue that JPMorgan is simply a custodian holding this metal for clients, not for a proprietary squeeze. These are valid points, but they miss the shift in incentives. Yes, the banks can suppress the price with paper, but only as long as they have some physical metal to deliver to the few who ask for it. When the registered stocks hit critical lows, the bluff is called. Regarding the hidden supply of jewelry, that metal requires refining. It takes time and energy to melt down grandma's tea set and turn it into a 1,000-ounce industrial bar in a supply crisis. That lag time is fatal. Furthermore, the argument that this is just client holdings ignores the legal structure of modern banking. In a bail-in scenario or a systemic collapse, the distinction between client assets and bank assets can become legally blurry, especially if those assets are rehypothecated. But even if it is for clients, who are the clients? They are the ultra-high net worth individuals and sovereign entities. The fact that they are stockpiling is the signal we are approaching one of three endgames. The first is controlled decline. The central banks manage a slow, grinding devaluation of the currency. Inflation runs hot at 4 to 6% for a decade. Silver prices rise steadily, perhaps doubling or tripling over 10 years, tracking the expansion of the money supply. This is the financial repression scenario seen in the post-World War II era. The second endgame is chaotic collapse. The bond market breaks. Yields spike uncontrollably. The central bank is forced to print trillions in a matter of weeks to save the system. This triggers a hyperinflationary pulse. In this scenario, the paper-silver market disintegrates. The price of physical metal detaches completely from the spot price. You might see spot at $30, but you cannot buy an ounce for less than $100. This mirrors the Weimar Germany dynamic of 1923. The third endgame is reset and restructure. The major powers convene in New Bretton Woods. They agree to repeg currencies to a basket of commodities to restore trust. Gold and silver are revalued overnight to clear the debt. In the 1930s, gold was revalued from $20 to $35. In a modern reset, the revaluation would need to be exponentially higher to cover the quadrillions in global debt and derivatives. In all three scenarios, the holder of the physical asset is the only one with a seat at the table. The holder of the paper claim is the creditor who gets wiped out. The accumulation of 169 million ounces is not a gamble. It is an insurance policy against the mathematics of the sovereign debt bubble. The squeeze begins when the market realizes that the vault is locked and the key is held by those who foresaw the inevitable. The only variable is timing and pain. Subscribe to the channel. Do not rely on the headline numbers. Study the warehouse receipts. Understand the difference between allocated and unallocated. Build resilience into your own supply chain. The data is there for those willing to read it.